Chris, you're in Spain for like a day, and now you look like a French sailor.
I'm trying to blend in. I'm trying to look less. Is it more inconspicuous?
I don't know. You're wearing the striped shirt like you should be in a French movie.
Well, I'm in Spain, so I guess I really should change my wardrobe a little bit.
Well, it's Europe. It all melds together when you're from the USA.
That's right. Actually, I was wearing a pair of American flag pants and American jacket, and believe it or not, it actually got pickpocketed.
Did you really?
No, I'm just kidding. Actually, no. Somebody did try. I felt somebody's hand in my pocket.
Really?
Yeah. On Saturday.
And wait, which pocket? Like your front pocket?
No, my back pocket where I would normally put my wallet.
How'd they get there?
You never put your wallet in the back pocket.
It wasn't there. I carry a bag here, but they were sticking their hand in my pocket, like trying to get at it.
Welcome to the weekly edition of the Pain Points of Wealth podcast, the podcast that addresses all the pain points that come along with creating, growing, and sustaining your wealth. Hosted by the family wealth experts of Payne Capital Management, Bob, Ryan, and Chris Payne. Please send us any questions or comments you may have to questions@paynecm.com. And please enjoy this week's episode.
All right, guys, we're having a little roundtable today. Payne Capital, just us, no guests. We've had a lot of great guests lately, but I thought it was important for us to chime in with our opinions, our thoughts on the economy, the stock market right now. And, the one question, Bob, everyone's asking is, are we in an artificial intelligence bubble? You've been through boom and bust. What do you think right now? Read the tea leaves for us.
As I've always said in the past, history doesn't always repeat, but it often rhymes. And it does feel very similar to what we experienced in the 90s. Now, again, where are we, though? Are we in 1995, 1997, 1999? The market from 95 to 2000, large cap growth, the tech trade outperformed for 5 straight years.
Bob, with your 60 years of experience, you would think you'd be able
60.
Close to 60.
50.
50, all right. I thought you started when you were 10.
Feels like it.
I thought you would know where we are in that cycle by now. And Courtney, you're on TV every week. And I'm curious right now, what are other, the prognosticator strategists saying? Do they think we're in the later stages, the beginning of stages? What's the view on AI on the street right now? Where do most people land in terms of where they think we are in this cycle?
Oh, it's across the board. I mean, you're hearing people saying this is nothing like the tech bubble. These companies have real earnings. These are real companies. It's nothing to worry about. We're in an industrial revolution. And then you hear people who are calling for an AI bubble. But I think realistically, the fact that this is asked on pretty much every segment of every news story you could watch right now, because everybody is concerned about this, or at least making the parallels. And I do think there are a lot of parallels to be made. Things are getting expensive. But on the flip side, usually when everybody is talking about a bubble, is usually not when the bubble's actually happening. Like there's still a lot of nervousness. There's still a lot of cash on the sidelines. You're not seeing that kind of euphoria that you get at the end of a bubble. I think that's the big takeaway that I see from all this.
Yeah, from an emotional perspective, right? The old famous line is markets die in euphoria. And Chris, what about with your client base right now? Are people asking you like, I want more artificial intelligence in my portfolio? Chris, I want to buy that double leveraged NVIDIA stock trade so that I can get double the upside when the stock market continues to go higher. Like, what are you seeing from your clients right now? Are they wildly bullish or are they still nervous?
I'm getting it from both sides, right? I get clients that call up and say, hey, Chris, what do you think about this AI stuff? Like I've never heard of it before. Should we be into that? Should we be investing in it? And then, recently I get an article a week from one of my clients, telling me that the AI bubble is going to burst. Like any moment now, it's ripe. It's going to be worse than what happened during the dot-com bubble. It's imminent. We should get out of this stuff right away.
Well, maybe that's the problem, Bob, right? Is we are an industry where people love to tell you they know, right? I mean, how many people, Courtney, on TV are so confident they'll tell you, this AI bubble or not a bubble or this AI spending is going to go on infinitely, right? There's so much more behind it. We're in the early innings. This thing's going to go much higher. And then you have other people, to both your points, that are nervous that we're in a bubble here. And I think that's the problem, Bob, this all or none proposition. Like we need to know when the top is, but it seems to me like no one's going to be able to predict the top.
That's always the problem I have with people from Wall Street. They act like they know, and don't you worry your little head about it, right? It's like, I'll take care of this. And you get the same people telling you today that they're all in long the Mag 7 trade, where 2 years ago they were guaranteeing you 100% that we're going into a recession. Now, why would you be long tech stocks going into a recession? So somebody's, somebody's telling a fib here. I'm not sure who. So the whole idea is that, yeah, this market is running away on the Mag 7. The earnings have been coming in. Let's truth be told, valuations are stretched. But meanwhile, there's tremendous opportunity in other parts of the market. Now, bonds have done really well this year. International's taken off. Emerging markets are doing great. And they have a lot of runway, right? And they have a lot better valuations, better dividend yields, a lot of opportunity. So I think that the key here is don't have too much of a good thing.
Yeah, too much of a good thing is too much of a good thing is what I've heard back in the day. And, I guess that is the real question here, Courtney, is, okay, if we admittedly know we have no idea where the top is, right? And it's going to be impossible to figure that out. And we know that, let's face it, things are more speculative right now. There's no getting around it, right? There's $1.1 trillion worth of margin debt out there. That's just people borrowing against their portfolio to buy stocks. I was just talking about there's all these leveraged funds that you can buy that give you double or triple the upside or downside. That's very speculative, that's probably later stage bull market type of behavior. So the question is, since we don't know when the top is actually going to be, how do you protect yourself as an investor? What's the strategy?
Well, I think it's really simple. I think you just want to be diversified in your portfolio, which is funny because I think a lot of people over the last 2 years have say, oh, the 60-40 portfolio is dead. They call it diversification instead of diversification just because everybody only wants to be in the tech trade. We fall into this trap too. Even on the podcast here, we're only talking about AI. That is not the whole market. Like this year, international, which Bob pointed out, outperforming your US large cap growth. So is gold. So are some of these things that just aren't as exciting as what the news talks about. I think that's what, as an investor, what you want. Don't get out of the AI trade. I think what we're all agreeing is probably not over here. You want to be in it if it keeps going up. But when it turns, it's going to happen before any of us can expect it. And so that's why you want to make sure you own all of these other things that are not as correlated to AI, that it's not going to affect you as dramatically.
100%. You don't want to live by the sword, die by the sword. And I think my problem right now, Chris, is just everyone on TV loves to tell you about what's already worked. And of course, to Bob's point, they pretend like they've owned it. And gold is the perfect example of that, right? Nobody was bullish on gold at the beginning of the year. I don't care what you tell me, nobody said gold was going to go up this year. Now, all of a sudden, everyone owns it. It's been a huge momentum trade. It sold off here a little bit in the last couple of weeks. But is it time to buy gold? Do you chase this huge momentum? Are there other places to put your money right now? Because it's kind of annoying when Wall Street's only telling you about what's already working. I want to know what before it happens, not after it happens.
Wait, Ryan, aren't you one of those guys on TV?
I'm the worst.
Yeah, again, I get that same question from clients. Hey, what do you think about this gold stuff? Do you think we should own it? The best part is I get to say, yes, we already own it because we do own it in our portfolio. But, it's like anything else. You don't want to overweight it. And, if you look at gold's performance over time, it doesn't keep pace with inflation. It's not a great investment, even though it is up almost 60% for the year.
It's a good point. It barely keeps up with inflation. Like if you put $10,000 in the S&P 500 in 1980, that's when Bob was, king of Wall Street. It'd be worth like 1.4 million today. If you put $10,000 into gold that year, you'd have like 70,000 today. So we know, Bob, over the long term, gold is a horrible investment. Pays no dividends. Has very little commercial use.
Well, that's why, Rye, you're always pushing digital gold. Cryptocurrency, baby. But what it comes down to is everybody wants to be in the in crowd, right? I met a money manager 30, 40 years ago, and he tried to be a contrarian, he was a really good value manager. And he said, but when you stand up in front of a room of your peers, you don't want to be the only one in the room that thinks one way, so even a true contrarian has a hard time being contrarian. Everybody wants to go with the flow. So it's almost when you talk to somebody who's on our industry, he's like, well, of course I'm overweighted tech in large cap, but I own everything else that's about to go up. But meanwhile, they all told us 6 months ago that emerging markets, was uninvestable, right? Europe is uninvestable. And I think you really have to, and it really got to be hard pressed. It's really hard for someone to be an investor, a true investor, because you got to be a true contrarian. It's easy to go with the flow, it's easy to buy high. It's buying value is really tough, and I think that's what we're really good at.
Hey, hope you're enjoying the most recent episode of the Pain Points of Wealth podcast. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially literally at any stage of your journey. But if you want a more hands-on approach and you saved over $1 million for your retirement, Bob, Chris, Courtney, and I will run for you our total financial master plan, and we'll do that with no obligation or cost. Simply go to www.paynecm.com/financial plan or click the link below to see if you qualify for a free financial review. It's time now for the Financial Autopsy. This is where we dissect a real financial plan. We talk about what you should be doing, shouldn't be doing, so you can make the right decisions with your own financial planning. Chris, you worked on a case recently. Why don't you break it down for us and talk about what this couple did, or you helped them do, to get on their path to what we would call financial independence?
Yeah, so this is a couple. They're in their late 60s. Actually, consistent listener of the Pain Points of Wealth podcast. So you heard it here first. Listen to our podcast for great financial advice.
Good taste. Right off the bat, we know they have
great
good taste.
Excellent taste. Yeah. So you know this is going to be a good one. But the one thing that they really resonated with them in listening to our podcast is that they're both in their late 60s, very aggressively invested. And the one thing that they heard through and through from our podcast is that they don't need to take a lot of risk. And more importantly, they need to find a portfolio that generates a lot of income.
Yeah. And when you say taking a lot of risk, was it mainly in growth stocks? Like, what was the breakdown of the portfolio? What did it look like?
Well, not only were they very aggressively invested, they were probably more invested appropriate to someone who is about 20 years younger. But they were also really heavily concentrated in those things that have just really done well the last couple of years. You know, the Magnificent Seven trade, if you will.
I think the issue, Chris, is that with a lot of people right now, because we had that big bear market correction, almost 20% in the first quarter this year, second quarter, that, people bought that dip. Now they think, wow, that's the strategy, right? I don't have to worry about downside, because downside is you're being bought. Did they understand that they could lose 60%? What was the motivating factor there? Now, a lot of people are thinking all I have to do is buy the dips and get rich.
Well, they certainly believe in long-term investing, but I think the real wake-up moment came when they said that this year is going to be the year that they retire. And I showed them a report that showed if they were invested the way they're invested now through the 2008 financial crisis, they would have been down 40, 50%. And that really woke them up.
Well, I think that's the scary problem right now is, right, a lot of people that are close to retirement or retired now, Court, I know you see this too with a lot of the reviews you and I do together, is they're taking so much risks. They don't realize how much risk they're taking. And if we do get a big sell-off, which can happen, they happen in the stock market, it could literally derail their entire retirement goals, which is wild.
I think we always see that pretty plainly and clearly because we're just looking at the math at the end of the day. But the emotion is very different for clients. And Chris, I'm curious, this couple that you were speaking to, I'm getting a lot of people who are in the same exact scenario that yours are, but they're saying, I completely agree with you. I know I need to take risk off, but I just want to I think the markets are still going to go up. Let's wait a little bit before we do it. Are you seeing that, or are they okay to take the risk off? And what was it that actually made them okay to pull the trigger? Because I think a lot of people are nervous to actually pull the trigger, even if they understand the logic.
That's not really the case here, Courtney. I mean, they aren't nervous about taking less risk. They definitely see the value in it. The big concern for them really is capital gains, right? They've done really well over the last few years, and they have big capital gains, and they're just saying, well, look, I don't want to have to pay all these taxes right away. So, we did come up with a strategy where they would take the gains gradually over time, and we'd be able to basically shift to lower risk assets in places like IRAs that wouldn't have that issue with capital gains.
Chris, the tax master, I like that. And I think that's a big problem, is the fact that people don't realize, okay, you could pay 15 to 20% long-term capital gains, which, it's not great. No one wants to pay the government, but that's better than if you have a sell-off and you lose 60%, right? And I think that's the math that most of us aren't running right now, Bob.
And that's not, I think that math is actually even worse than people realize, because you can lose 60% of the entire value of your account. The 15 to 20% is just on the gain, right?
Yeah.
So it's actually not even, that discrepancy is even worse. The taxes are much smaller typically than your downside potential in a market. And that's what you have to weigh out as an investor.
No one really understands the stress of being in an aggressive portfolio in a bear market. And where bear markets continue to go down until you get out, right? They beat you. They beat you down mentally to you. I've heard this so many times in my career. I just can't take it anymore. Get me out, right? So it is all emotional, and it's so hard for someone to understand is, well, I've done so well. How could something that's so good be so bad right now? And it's just a matter of understanding, what your needs are. And as I always say on the podcast, we already solved the investment problem, right? We know how to create wealth. It's, I think the sole reason that Payne Capital exists is to help people deal emotionally with being successful as an investor.
All this time I thought Payne Capital exists so Ryan could have a podcast.
Actually, the podcast was your idea, Chris.
That is the real reason. But Bob, I think the emotional component is so critical. And what you just said, Courtney, right now is the fact that it's like, I just feel like it's going to go higher. Well, feel like it's going to go higher is a very bad way to run your money for retirement, right? To predicate it on that feeling. Because Bob, you said it earlier in the podcast, what's going to make the market turn is not something we can anticipate. It's going to be a black swan event. It's the old proverbial, when the tide goes out, you can see who's been swimming naked. And I suspect right now there's a lot of people in their 60s, 50s, 70s that think that they're not taking that much risk and have no idea what's going to happen when we do go into that bear market and how bad it's going to be for their portfolio. So you have to be proactive about risk, not reactive. And I think that's the problem right now.
Yeah, and I think in a vacuum, if you're just looking at it, it's not that complicated, right? I think it's, without having true goals, it's like a laissez-faire approach to your portfolio. It's like, so what if it goes down a little bit? I mean, people just don't comprehend, how destructive a bear market will be. And it's, I think it's so key to make sure that you have an allocation that's based on what you're trying to accomplish, as opposed to, what's going to do well. Because it's not a competition. It's not like, oh, well, my neighbor made more money in NVIDIA than I made in international. So it's not a competition. It's not about having the most return. It's about having the adequate return. And I think that's so hard to communicate. To us, it's common sense. But to some folks, it's just like we're speaking a different language.
Yeah, it's a great point. And look, I don't care if my neighbor gets rich. I just don't want Chris to make more money than me, just for the record. But, Chris, it's another good point is what we found right now is if you spread your money out, there's so many places to get income. And income is much more reliable than the ups and downs of the market. So I'm curious, when you re-diversified this couple's portfolio, were you able to increase the income sizably? Whereas they could just be dependent on that income every year. They don't have to worry about, is NVIDIA going to keep going up next year? Or is the tech trade going to be over next year? Were you able to optimize the income on their portfolio? Because that's what most people, I think, can do right now. They're not doing it, which is a huge opportunity.
Yeah, we were, and in many different ways. So, the first thing that I did off the bat, as always, we run that wealth projection. So I figured out exactly what they spend to the penny. And we looked at Social Security, and then we looked at what the portfolio will potentially generate. Not only will the portfolio generate enough income to cover all their expenses, they'll actually have a surplus every year. And then you add Social Security on top of that, their portfolio is just going to continue to grow as time goes on. The other thing that we found is that, any dividends that they did have paying in the portfolio and interest were all taxable. So, we could buy tax-free municipal bonds. So then, not only is that income being paid out to them, it's going right in their pocket because they're not paying taxes on it.
Yeah, and I think it's an old fallacy, Chris, that, once you retire, you're going to be in a lower tax bracket. But we found that most of our clients are in the highest tax bracket the rest of their life. So it's, you really can't depend on your bracket being lower and paying less taxes. And let's face it, taxes have it's a huge headwind, to achieving your financial goals.
Chris, you're able to reduce risk, increase their income, and optimize for taxes. I would call that a financial masterpiece.
Thanks for listening to the Pain Points of Wealth. Hopefully you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Ryan, and Chris's firm, Payne Capital Management, at bebullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Pain Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.